Hello everyone, welcome to the market opening bell for Monday, February 2nd, your 10-minute guide to the stock market. After rising for 7 consecutive trading days, the Hang Seng Index pulled back last Friday. It opened low by 182 points with the decline widening to a low of 27,384 points before closing at 27,387 points, down 581 points or 2.1%. The Hang Seng China Enterprises Index fell 235 points or 2.5% to close at 9,317 points. The Hang Seng Tech Index dropped 123 points or 2.1% to 5,718 points. Total market turnover reached 301.6 billion Hong Kong dollars. Southbound funds net bought $4.374 billion worth of Hong Kong stocks. Among the key net buys were Tracker Fund at 2.395 billion, Tencent at 800 million, Xiaomi at 643 million, Zhaojin Mining at 148 million, and Hua Hong Semiconductor at 113 million. On the sell side, net sales included China Mobile at 645 million, Zijin Mining at 377 million, Alibaba at 330 million, Zijin International at 215 million, SMIC at 162 million, and CNOOC at 113 million. Statistics show that southbound funds have net bought Tencent for 5 consecutive days, totaling 4.288 billion. They have net sold China Mobile for 19 straight days, totaling $15.434 billion. Net sold Alibaba for 5 consecutive days, totaling $3.402 billion. Net sold Zijin Mining for 4 days, totaling $3.15 billion. And net sold SMIC for 4 days, totaling $1.172 billion. Several factors contributed to the decline in Hong Kong stocks last Friday. U.S. tech stocks dragged the market down as the U.S. market was volatile the previous night, with Microsoft experiencing its largest single-day drop in nearly 6 years, and Apple warning of margin pressures. The Hang Seng Index had risen for 7 straight sessions prior to this, reaching a 4.5-year high. On the last trading day of the month, investors tended to lock in profits, leading to widespread profit-taking and a broad market pullback. Commodity stocks plunged sharply as international gold and silver prices tumbled, weighing heavily on Hong Kong-listed gold and resource shares. For example, Shandong Gold and Zijin Mining saw significant declines. For the week, the Hang Seng Index still rose 638 points or 2.4%. The China Enterprises Index gained 1.7%, while the Tech Index fell 1.4%. In January, overall, all 3 major indexes posted gains, with the Hang Seng up 6.8%, the China Enterprises Index up 4.5%, and the Tech Index up 3.7%. Technically, the Hang Seng Index low of 27,384 points last Friday can be seen as a pullback after breaking above the rectangular top at 37,381 points. Additionally, an upward gap of about 70 points was left on Wednesday last week between 27,188 and 27,258 points. Filling this gap would make the trend healthier. In Asia, as the 3 major indexes diverged last Friday, the Shanghai Composite fell 40 points or 1% to 4,117 points. The Shenzhen Component dropped 94 points or 0.7% to 14,205 points. The ChiNext Index rose 41 points or 1.3% to 3,346 points. Combined turnover in Shanghai and Shenzhen reached 2.84 trillion yuan. Over the past week, Shanghai and Shenzhen markets showed high-level oscillation with mixed performance. The Shanghai Composite fell 0.5% for the week. The Shenzhen Component dropped 1.6%, and the ChiNext Index edged down 3 points. Despite the adjustment on Friday, the Shanghai Composite rose about 3.8% in January, achieving a positive January effect. The central parity rate of the renminbi against the US dollar rose 93 points to 6.9678, the highest since May 16th, 2023. The onshore renminbi appreciated about 0.2% against the dollar last week, heading toward a 10th consecutive weekly gain, the longest streak since 2013. Key drivers included a significant retreat in the US dollar index and increased seasonal forex settlements by exporters. Recent trader feedback and intraday volume suggest this settlement wave shows no signs of slowing. Over the weekend, the National Bureau of Statistics released China's official Purchasing Power Managers Index (PMI) for January 2026, showing unexpected contraction in both manufacturing and non-manufacturing activity, partly due to seasonal factors, normal fluctuations before the Lunar New Year holiday, and weakening domestic and external demand. Manufacturing PMI fell to 49.3 from 50.1, below the market expected 50. The production index was 50.6, still expanding but at a slower pace. The new orders index was 49.2, indicating contraction on the demand side. New export orders stood at 47.8, reflecting weak overseas demand. Non-manufacturing PMI dropped to 49.4 from 50.2, with the construction index plunging to 48.8. The services index was 49.5. The composite PMI output index fell to 49.8 from 50.7, signaling an overall slowdown in business activity. Notably, the high-tech manufacturing PMI remained at 52, showing continued rapid growth and ongoing industrial structure optimization. For Caixin, manufacturing PMI is expected to be released today. According to sources, China is considering issuing hundreds of billions of yuan in special treasury bonds to recapitalize some large insurance companies and strengthen leading firms under integration pressure. One source indicated the issuance could raise about 200 billion yuan for capital supplementation in state-owned insurers, including China Life, PICC Group, and China Taiping. This would mark the first time Beijing uses special bonds to inject capital into insurers, expanding beyond channels previously used for major state banks. The plan may be announced as early as the first quarter, with additional injections of 300 billion yuan planned for ICBC and ABC, continuing similar bond issuances from last year that supported banks like Bank of China and Bank of Communication. On policy news, the Ministry of Finance and State Taxation Administration recently issued announcement number 9 of 2026 on the specific scope of VAT taxable items effective January 1st, 2026. Services providing mobile data, SMS, MMS, and Internet broadband access via fixed line, mobile, satellite, or Internet networks will shift from value-added telecom services to basic telecom services, raising the VAT rate from 6% to 9%. The change will impact the revenue and profits of the three major telecom operators, since telecom tariffs are typically quoted inclusive of tax. The higher rate means reduced net income after VAT deduction without raising user fees. All three companies emphasize accelerating AI plus initiatives, cloud to digital transformation, and other strategies to offset financial pressure through innovation and efficiency gains. This helps explain the persistent southbound selling of China Mobile. On the Hong Kong stock front, Panama's Supreme Court ruled two local port contracts unconstitutional, causing CK Hutchison to fall 4.6%. Rumors surfaced that New World could change hands with Blackstone in talks to become the largest single shareholder. New World's controlling shareholder confirmed investor approaches, and the stock rose 2.2%. CSPC Pharmaceutical plunged over 10% on heavy volume. The company announced a strategic R&D collaboration and licensing agreement with AstraZeneca, leveraging CSPC's proprietary sustained release platform and peptide or AI discovery platform to develop innovative long-acting peptide drugs. Under the terms, they will collaborate comprehensively on discovering innovative peptide molecules and developing long-acting delivery products. Beyond advancing existing preclinical long-acting peptide pipeline, CSPC will also discover and develop other innovative long-acting peptides for AstraZeneca. Although the potential deal value is substantial, including over 9.3 billion Hong Kong dollars in upfront payments, the market had already priced in expectations, triggering profit-taking upon confirmation and a sell-on news reaction. Concerns linger over CSPC's traditional drug segments, such as oncology and neurology products, pressured by volume-based procurement policies and risks from generic competition for core products like Anbipao and Jinyoli, which could weigh on revenue and profits. Automakers released January sales data showing clear weakening. BYD sold 210,000 vehicles, down 50% month-on-month and 30.1% year-on-year. Li Auto delivered nearly 27,700 vehicles, down 37.5% month-on-month and 7.5% year-on-year. NIO delivered 27,000 vehicles, down 43.5% month-on-month, but up 96.1% year-on-year. XPeng delivered 20,000 vehicles, down 46.6% month-on-month and 34.1% year-on-year. Geely Auto sold 270,000 vehicles total, up 14.1% month-on-month and 1.3% year-on-year. Its Zeekr brand delivered 23,800 EVs, down 21.2% month-on-month, but up 99.7% year-on-year. Great Wall Motor sold 90,000 vehicles total, down 27.2% month-on-month, but up 11.59% year-on-year, with 18,000 new energy vehicles. Series sold 45,000 vehicles, down 27.9% month-on-month, but double year-on-year. Xiaomi delivered over 39,000 Xiaomi cars, down 22% month-on-month. The domestic reports note that Xiaomi SU7 Ultra sales at just 45 units in December 2025, far below March's peak of 3,101 and the 2,000 to 3,000 monthly range from March to August last year, dropping sharply to 488 in September and 130 in October. Sources also indicate first-generation SU7 production has halted, with the factory focusing on the next-generation model. China Southern Airlines issued a profit warning, especially expecting 2025 net profit between 800 million and 1 billion yuan, versus a 1.696 billion loss the prior year, achieving a turnaround. This stem from seizing market opportunities, precise capacity deployment, optimized passenger cargo layouts, and enhanced cost controls, improving operational efficiency. In contrast, Air China issued a profit alert forecasting a 2025 loss of 1.3 billion to 1.9 billion yuan, wider than the prior year's 237 million yuan loss. This resulted from strict accounting standards requiring a review and partial reversal of deferred tax assets at year-end. Air China posted 1.87 billion yuan profit in the first 3 quarters of 2025. Per the alert, the fourth quarter likely saw a single quarter loss of 3.17 billion to 3.77 billion yuan. The market had expected steadier profits from the 2025 recovery cycle, but this alert has shaken those profit rebound expectations. Vanke issued a profit alert projecting a 2025 loss of 82 billion yuan, wider than 49.478 billion yuan the prior year. This was mainly due to a sharp drop in real estate development project settlements and persistently low gross margins. Settlements during the period primarily informed 223 to 224 sales projects, and 225 digested near completed inventory, with high land acquisition costs leading to significantly reduced settlement gross profit. US stocks fluctuated sharply last Friday, with the VIX Fear Index rising 0.56 points or 3.3% to 17.44. The Dow fell as much as 611 points or 1.2% to a low of 48,459 before narrowing losses to close down 179 points or 0.4% at 48,892. The Nasdaq fell 223 points or 0.9% to 23,461. The S&P 500 dropped 29 points or 0.4% to 6,939, marking 3 straight down days. The Nasdaq China Golden Dragon Index, reflecting Chinese concept stocks, fell 187 points or 2.4% to 7,732. Hong Kong stock ADR suggests the Hang Seng Index will open about 132 points lower at around 27,254 on Monday. For the week, the Dow fell 0.4%, and S&P 500 rose 0.3%, and the Nasdaq retreated 0.2%. For the month, the S&P 500 and Dow gained 1.4% and 1.7% respectively, while the Nasdaq rose 0.9%. Apple reported a 16% rise in quarterly profit, beating expectations, with iPhone sales up 23%. The stock dipped over 2% intraday but closed up 0.5%. Big tech stocks were mixed. Tesla rose 3.3% against the trend amid rumors of a potential SpaceX merger. Microsoft down 10%, Thursday still fell another 0.7%. Meta up 10% earlier, gave back 3%. Nvidia dropped 0.7%. SanDisk beat expectations on quarterly results and guidance, surging as much as 25.5% to a record high of $676.69 before closing up 6.9% at $576.25. U.S. President Trump announced the nomination of former Fed Governor Kevin Warsh as Fed Chair. Warsh's relatively hawkish stance has eased market concerns over aggressive rate cuts and Fed independence. Precious metals plunged across the board Friday, with spot gold crashing 26% to $85.2, low of $73.9603 in a washout, narrowing January's gain to 18.9%. Spot gold fell over 12% at one point to below $4,690 amid a stronger dollar. The dollar index rose 0.9% to 97.147. U.S. December Producer Price Index (PPI) rose 0.5% month on month, above the expected 0.2%. Core PPI rose 0.7%, also beating 0.2%. Year-on-year PPI increased 3% versus expected 2.8%, and core PPI was up 3.3% versus down 2.9%. Markets this week will digest Warsh's nomination impact and monitor Senate confirmation. On earnings, focus will be on Amazon and the US UPS layoffs and guidance. Key economic data includes the January nonfarm payrolls report to assess labor market stability 2026. Our stock pick today is Oriental Selection, stock code 1797. Oriental Selection announced its interim results for the 6 months ended November 30th, 2025, after going through the painful period of separation from Yu Hui Tongxing with Hui. The company successfully turned losses into profits. During the period, total revenue increased by 5.7% year-on-year to 2.3 billion yuan. Excluding the total revenue generated from the Yuhui Tongxing live streaming room, total revenue increased by 17% compared to the same period in 2024. Net profit was 239 million yuan compared to a net loss of 96.5 million yuan in the same period of 2024. Gross profit for the half year increased by 14.5% to 841.6 million yuan, and the overall gross margin rose from 33.6% in the same period last year to 36.4% in the reporting period, mainly due to the healthy development of self-operated products and live e-commerce business. The group has made significant progress in product development and supply chain optimization, expanding its product categories from the initial fresh food and snacks to a more diversified range. As of November 30th, 2025, a total of 801 SPUs of self-operated products had been launched, compared to 600 SPUs as of November 30th, 2024. New categories include seafood and aquatic products, nutritional and health foods, kitchen condiments, meat, eggs and dairy, tissues and wet wipes, personal care and household cleaning products, home textiles and apparel, underwear. These new products precisely target consumers' specific demands for health and convenience, not only enriching consumer choices but also effectively driving overall sales and profit growth, thereby further optimizing the product structure. The group uses traceability live streaming to deepen consumers' understanding and trust in its self-operated products. Self-operated products continue to be the main growth driver, accounting for 52.8% of total GMV, effectively improving overall profit margins. In terms of cost optimization, the group has implemented measures such as centralized procurement and control of foundry costs to maintain healthy product growth. At the same time, it continues to optimize the existing warehouse network layout and enhance operational capabilities. In addition to origin direct delivery products, the company plans to build same-day delivery capabilities in the top 10 cities by domestic order volume. Orders placed before 10:30 a.m. will be delivered on the same day, and orders placed before 11 p.m. will be delivered by 3 p.m. the next day. Pilot programs for instant retail fulfillment capabilities will also be launched in Beijing, Shanghai, and Guangzhou. In terms of logistic infrastructure, following the commissioning of Huazhong Warehouse Number 1 and Number 2 in 2025, the construction of Oriental Selection Warehouse Number 3 and Number 4 will be completed, and new warehousing operation standards and cargo management measures will be formulated. Looking ahead, the group will adhere to the high standard product selection principles, whether for self-operated products or goods from partner brands. It will further strengthen the intensity of quality inspection and control. It would also leverage AI to improve operational efficiency, innovate live streaming models and content ecosystems, and develop live streaming teams and professional talent pools. Recommended buy price $25. First target to $27.50. Next target $29. Stop loss at $23.50. I do not hold the above stock.